Your hard-earned money can just disappear. Shopify tax mistakes are a really serious danger for new online sellers. Many people jump into e-commerce with big dreams of earning good money. They think about marketing, inventory, and shipping, but often forget taxes. Ignoring tax rules leads to huge financial problems. You might face hefty financial penalties and interest. Some new sellers start selling without registering for sales tax. This is a common and highly risky error. Every state in the United States has its own sales tax laws. 5 states, like Alaska, Delaware, Montana, New Hampshire, and Oregon, have no statewide sales tax. Others, like California, have a base rate of 7.25%. Local, city, and county taxes push that rate higher. Some California areas might pay over 10% sales tax. Selling $100,000 worth of goods means $10,000 needs to go to the government. If you keep that money, you are in big trouble. Another mistake is not understanding Nexus. Nexus means a connection. It decides where you collect sales tax. A physical presence in a state creates sales tax nexus. This could be a physical store, an office, a warehouse, or even employees working from home. Some states also have economic nexus rules. These rules mean you must collect sales tax if you meet certain sales thresholds. For example, a state might require collection if you have 200 separate transactions or $20,000 in sales to customers in that state during a calendar year. You might not have any physical presence there, but if you hit those numbers, you still need to register and collect. Many sellers operate from one state, but sell to all 50 states. They must monitor sales volume and transaction count for every state. This is a massive job. Tax compliance software like Avalara or TaxJar can help. They track Nexus automates sales tax calculations and filings. Failing to register for sales tax where you have Nexus leads to huge fines. Fines can be 100% of the uncollected tax, plus interest piles up fast. Income tax is another area where new Shopify sellers make errors. Many new businesses operate as sole proprietorships. Business income and expenses flow directly to the owner's personal tax return. Some people forget to set aside money for taxes throughout the year. They get a big surprise during tax season. The IRS expects estimated taxes quarterly. This means 4 times a year. Deadlines are typically April 15th, June 15th, September 15th, and January 15th. Not paying enough estimated tax incurs penalties. These are often a small percentage of the underpayment, but they add up. It is smart to save 25 to 35% of your net income for taxes. Keeping business and personal money separate is also critical. Do not mix your funds. Open a separate business bank account right away. This makes tracking income and expenses much easier. It helps a lot during an audit. Inventory valuation is often overlooked. For tax purposes, you need to value inventory correctly. This affects your cost of goods sold. A higher cost of goods sold means lower taxable income. Common methods include first in, first out FIFO or last in, first out LIFO. The method you choose impacts your tax liability. You need to be consistent. Changing it without IRS approval causes problems. Shipping costs are another gray area. How you treat shipping revenue and expenses affects taxes. Some states tax shipping charges, others do not. Know the rules for each state where you collect sales tax. This adds to complexity. Returns and refunds also affect sales tax obligations. If you refund a customer for a purchase, you might reclaim sales tax already sent to the state. But specific state procedures must be followed. Many Shopify stores want to sell internationally. This opens new tax issues. Selling to European Union customers requires understanding, VAT. This is a consumption tax. It is similar to sales tax, but applied at each stage. If you sell goods to EU customers, you might need to register for VAT in one or more EU countries. The EU has a new VAT e-commerce package. This simplifies things through the one-stop shop OSS scheme, but it is still complex. You might need to charge VAT at the customer's country rate. This rate varies widely. Some countries have a 20% VAT, others might be 25% or even higher. The UK has its own VAT rules post-Brexit. Selling to Canadian customers means dealing with GST and PST. Australia has GST too. Each country has import duties and customs regulations. These add to the cost of international business. Incorrectly handling international taxes causes customs delays, goods being seized, or steep fines. Record keeping is not exciting, but it is super important. Keep accurate records of all sales expenses, inventory, and tax payments. The IRS recommends keeping records for at least 3 years. Some states may require even longer. Good records protect you in an audit. They help file accurate tax returns. Use accounting software like QuickBooks or Xero. Link it to your Shopify store. This automates much data entry. It categorizes transactions properly. Manual record keeping is prone to errors. It takes a lot of time. Many new sellers start with spreadsheets. As sales grow, this becomes unmanageable. Investing in proper accounting tools saves headaches. Without good records, it is hard to prove income and expenses. This puts you at a disadvantage if an auditor comes. They can disallow deductions or assess additional taxes. Not claiming all eligible tax deductions is another common mistake. Many business expenses are tax deductible. This lowers your taxable income. Things like advertising costs, website hosting, Shopify, subscription payment processing, professional services, home office expenses, shipping supplies, and employee wages are usually deductible. Keep receipts or clear records for all these expenses. Using your personal car for business trips allows mileage deduction. The IRS sets a standard mileage rate. For 2024, it is 67 cents per mile. These deductions really add up. Missing out means paying more tax than you should. Some sellers do not know what they can deduct. Others are just too busy to track. A good accountant identifies all potential deductions. They can save thousands of dollars. Seeking professional advice is often overlooked. Many new Shopify sellers try to handle taxes themselves. They think they can save money, but tax laws are incredibly complex. They change constantly. A qualified tax professional, an e-commerce accountant, or bookkeeper specializing in e-commerce is a game changer. They set up your accounting system correctly. They ensure you are registered for necessary taxes. They advise on nexus issues and international sales. They prepare and file your tax returns. The cost of an accountant is often much less than potential penalties and missed deductions. Do not wait until trouble strikes. Get help early. Think of it as an investment. Paying a few $100s for advice saves thousands later. They provide peace of mind. They help you focus on growing your store. Not worrying about tax compliance is a huge benefit. Business growth depends on smart financial decisions. Taxes are a huge part. Understanding these common Shopify tax mistakes is the first step. It protects your profits. It ensures a solid foundation for long-term success. You want a thriving online store, not a tax nightmare.